Hi everyone, my name is Paul Sankey. I first joined the International Energy Agency out of college in 1990, right when Saddam invaded Kuwait for the first time. And 10 years after that, I became a sell-side analyst. And for the last 20 years, I've been top-ranked oil analyst, or part of a team at least, that was top-ranked in oil or energy adjacent in both the City of London and Wall Street. That's my intro. This week, we'll be talking about Scott Bessent, the Trump appointee for Treasury Secretary, which was very anticipated, not in terms of Scott, but the general appointment was very anticipated by Wall Street, and we'll see how the market reacts today to somebody who has a sterling CV in terms of hedge fund history. He's worked with some investment legends, Jim Rogers, George Soros, Stan Druckenmiller, and actually had a bit of a mixed record running money himself, but ultimately is pretty much a Wall Street guy. As far as I can tell, he's not that well known on Wall Street to us, but as far as I can tell, he knows a lot of people, and Trump has chosen him. The one thing that comes out, because a lot of the interviews, and he's done it a lot, is that he has this 3 threes plan, which is to increase economic growth to 3%. It's not far off that, I guess. And it's not at 3%, but it's still a high number for an economy the scale of the US. To reduce the deficit to 3%, which is currently running at about 7%, a huge deficit is his big thing as a problem for the US. And to weirdly increase US energy production by 3 million barrels of oil equivalent a day, which is a little bit of a twist because he doesn't have any details about how he's going to do that. And he has somewhat cleverly used 3 million barrels of oil equivalent a day and talked about energy. So it's not just oil. You could probably get there with a lot of LNG permits. But those 3 threes that Bessent is talking about are somewhat mutually incompatible, particularly the first two, because if you cut the deficit, you're actually going to also cut economic growth in the short term. And the way they're probably going to do it, which is worrying to us and Wall Street, is through tariffs. And if you're using tariffs, again, you're going to cause a lot of global economic problems. You'll probably juice the US economy in the short term. But tariffs generally, I mean, I'm a free trade guy. I'm not sure that trade with China is really free because the Chinese don't have the same labor laws and, you know, general environmental requirements. Actually, environmentally, the Chinese are pretty tough. But certainly it's not really a level playing field in terms of competing with the US. So it'll be a major potential worry for the market that we're going to get a lot of tariffs under Trump. I believe Trump has said that tariff's the most beautiful word in the dictionary or something, which wouldn't be the word I would choose. But there it is. So Scott Bessent has been appointed. A lot of these appointments, as you know, are subject to confirmation, but he doesn't seem that controversial ultimately, even though his history with MAGA and his husband and son make it kind of an interesting choice, and not to mention his history with Soros. But of course, it's widely seen that he's distanced himself considerably from Soros over the past 10 years or so. And there's been actually a couple of furious responses to people accusing him of being some sort of Soros conspiracy guy, basically because he's no longer associated with the man. Anyway, that's Scott Bessent. And this really goes back to the drill baby drill thing that Trump's been talking about, which is kind of inexplicable to rationalize in terms of how you're going to do that. Because as we keep saying, the US oil companies have got capital discipline. And the investors who are my clients, those are the guys that give us the top ranking, really don't want the companies to go out and spend a ton of money. So, you know, just casually saying, as these guys do, hey, we're going to increase US oil and gas production by 3 million barrels a day from an already super high base, is sort of meaningless, quite frankly. The 3 million barrels actually is getting a synchronicity, because 3 million barrels a day is about what Saudi spare capacity is right now. And we've been talking about that in terms of how you look at global oil inventories, because you'll see some oil bulls talking about global oil inventories being low, for example, versus their 5-year history. And the 5-year history historically has been important because that's been the way that Saudi and OPEC look at inventories. So if you're below the 5-year history, you are tight, and people are arguing that basically that tightness is going to lead to better pricing than the market currently anticipates, because professionals are very, very bearish oil here, for the simple reason that in OPEC alone there's somewhere between 4 and 6 million barrels a day of spare capacity, depending on how you count it. 3 million in Saudi, 1.5, call it, in the UAE, 0.5 to 1 in Iraq, depending on how you count it. So just in 3 countries alone, you have 5 million spare. And our argument is that that's inventory. So people who are arguing that stocks of oil are low, and I mean stocks as inventory, are simply missing the fact that you can consider spare capacity to be inventory. And that's a key reason why we're pretty bearish here. Now, having said that, we think the physical market is in equilibrium as we go into winter, basically because Saudi is holding all that oil off the market and is pushing the rest of OPEC not to increase production. So the struggle that barrel counters are having is whether or not OPEC is seriously going to increase into a market that just doesn't need the oil at the level that they've got the oil. And there's significant tension here because the UAE definitely just wants to increase production regardless, because they're only using about 65% of their capacity, which is in percentage terms lower than Saudi. And I think the UAE is very much, Abu Dhabi basically is very much of the view that you just got to produce this stuff, because if the oil age ends and they're left with 100 years of reserves, they have made economically the wrong decision. We also highlighted, by the way, how long it took UAE to build a nuclear plant, which is, essentially the most, you could call it arguably the easiest place in the world to build a major nuclear plant, which they did. It's 4 times 1,200 megawatt plant. So an enormous, 5 point, whatever that is, gigawatt nuclear plant that they originally announced in around 2009 and said it would cost about $20 billion. It's finally fully started up in this year in 2024 and cost $30 billion. And, the point we're making is that this is the most, as I say, the easiest place to build a major nuclear plant, because you don't have the environmental opposition, you don't have the regulatory opposition. Essentially, there's a place where people build big things very fast with government support, and that's how long it took them to build a major nuclear plant. And of course, that leads people, including us, to be very bullish for natural gas, because you can put natural gas in within a couple of years, depending on if you can get turbines. Turbines are actually sold out at the moment. And one of the stocks we like is GE Vernova. Another which we think is a stealth play on turbines is Baker Hughes, and that's the one service company that we like, because we think that capital discipline is still going to be a major feature of the oil company strategy going forward. But there's a couple of key exceptions. The first is another 3 million barrels a day, which is this past week, Kuwait announced a $30 billion investment program in increasing their oil production capacity by, you guessed it, 3 million barrels a day. So there's this incredible pressure, and I think it's, as I've said many times, basically led by technology, that you can develop oil much more quickly at much lower prices than you could historically. And oil reserves were never the problem. It was always a question of cost. So unlike, for example, Bitcoin, where you have a known ultimate recoverable reserve, Bitcoin will only ever be 21 million of them, which is what gives it its value. With oil, depending on your price assumption, it's essentially unlimited, because you can crush coal to oil at $150, $200 a barrel if you really want to. That's why long-term forecasts of super high oil prices are so misguided. Additionally, as you know, and we've talked about this a lot, demand, particularly in China, is rolling over, particularly for transport fuels, ex-jet fuel. And everybody who's still bullish China and global oil demand is really looking for increased demand from petrochemicals, which is not black oil, it's not what OPEC counts, it's typically liquids, things like ethane. And there's abundant supply of that, and furthermore, pretty bad chemical margins right now. So there's too much chemical capacity in the world. So I'm very skeptical about long-term bull forecasts for petrochemical demand, simply because the market's just not that tight right now. Of course, it's all very dependent in petrochemicals on GDP growth. And one of the arguments we've made is that weak oil prices are actually going to constrain the US economy, which is where the Treasury Secretary's analysis falls down. He's not talking about price assumptions. He's not talking about the behavior of the oil companies and whether they want to invest. He's just saying, let's add 3 million barrels a day of capacity. And what worries us is that they're going to do something crazy like ban US oil exports just to bring down oil prices. And we're very worried about that. So we are concerned about the oil market. Here in the UK, just to finish off on the UK, we were very critical of UK government policy in terms of the North Sea. We think the UK has done a great job of adding a renewable capacity. Yesterday, you were over 50%, you were 53% electricity generation from wind. The wind was so strong that they actually had to pay wind producers not to produce. I think Javier Blas was saying it was about 20 million euros, was it? Some fairly significant amount of money because there was too much wind supply. And I was also interested that it was 3% of electricity came from solar. Here now, the wind has settled down, and so the number will be much lower, but at the same time, it's much warmer. And what's got people excited in markets in the past week has been a very cold outlook relative to normal in the US. Here in the UK last week, it also turned very cold and there were significant storms, but today is really quite warm. And over in Northeast Asia, which is key for the whole China demand story, what you'll find is actually it's still pretty warm as we head into winter. But of course, you don't really call these things until January, February, and we're in late November. So the early cold in the US is super bullish for US natural gas in the short term. And that's got people buying something that they want to buy already, which is natural gas stocks. Kids are feeding the pigeons here. Actually, the reason I'm hanging around here, yeah, people are buying US natural gas stocks because you have a real double whammy there of the AI theme, because as I mentioned, the only way you're going to meet AI electricity demand is through natural gas power because it takes so long to build nuclears. People are excited about something like Oklo, which is a SMR company, a small nuclear reactor. And, you know, we can definitely see a potential role for SMRs, small modular reactors, yeah. In the US, Oklo is a hot stock on that theme. Otherwise, we're still liking things like Vistra, even though they've absolutely ripped Constellation. Things that are exposed to this, because as oil analysts, as I've kept saying, we know when companies such as the Magnificent Seven decide they're going to spend an absolute ton of money on a theme such as AI, and they're basically in an arms race, these companies won't back off for a couple of years. And so the AI spend theme, where you buy the picks and shovels, you buy the natural gas stocks, we think has legs, even though the stocks have absolutely ripped. And of course, in general, the market knows that Trump sees the S&P 500 as a popularity indicator, and the man wants popularity. And so, you know, he's probably going to do all sorts of things to juice the market, even though it's already extremely juiced. Torsten Slok, who's a very good economist on Wall Street for Apollo Group, his boss's boss was one of the candidates for Treasury Secretary, and that was the guy that we preferred to be Treasury Secretary because he's known to be a brilliant man. But Torsten was pointing out on a normalized basis that the market is now at something like 32 times earnings. Its history is 17 times earnings. Within that, he can buy cheap stocks, such as one we liked this week was EOG, where they have a big buyback. They're going to re-lever the balance sheet. It's an exceptional company. We like that one. We were very impressed by Suncor's results, which is doing really well with activist pressure. And those activists across the board are potentially very positive for the oils. One name that we think should be basically activized is BP. We'll wait to see if something happens there. We've been calling basically for the board to be fired. It's been that bad. And we've said the same thing about Apache. And we've looked at the breakup value there. For Apache at $60 oil, we get the stock is worth $8. It's trading at 22. So you can see that we're not thrilled about oil at all. On refining, we're pretty interested because margins have been so bad, ironically, and we're looking for winter to show up. And when we do our refining conference in January, we'll be typically every year you're looking to try and buy the refiners into a major rally. One thing that refiners and some of these cash taxpayers will benefit from will be lower taxes under Trump. And Besson's first job next year will be what to do with the Trump tax cuts, which expire next year. And so that will be one of the major issues of Congress next year in the US, is getting through tax. Okay, I'm going back to the US. I was here looking for parakeets. There are no parakeets, there are pigeons and the odd rat. But I'm not sure if they migrate. But for the bird watchers, I'll give you a symbol of London, which is, I don't know if you can see him, a big fat pigeon. Have a great week.